Hey everybody, welcome to Coffee with Chris. Today we are going to be talking about the S&P 500. Specifically, we're going to be talking about the S&P 495 and the S&P 5 and what's the difference between those two and the returns year to date. And so Chris, give us an idea of what the difference between, what is the S&P 500 and what's the S&P 495 and what's the S&P 5 and
every combination of them.
Right. Simplify the question for me, thank you.
Right.
Well, the S&P 500 is a common index that traditionally is thought to measure the large cap stocks of the U.S. Now, there's mid and small in there as well, but by and large, U.S. large caps. And the S&P 5 that have been popular for 2 or 3 years now, but the fangs turned into the fames, which is Facebook, Apple, Amazon, Alphabet, which is Google, and Microsoft. And those 5 stocks are the drivers of the return of the S&P 500 this year. So they're 30+% in return year to date versus the S&P 495, which is in negative territory, so about -1+%.
Right.
And the challenge when you look at those, when you think about that, is that those stocks have so far outpunted their coverage that it's really a big red flag to me when we're looking at it. It's really getting really bubblicious there.
Mm-hmm. That's a great word.
Bubblicious. Yeah, that's right. That's right.
So we're looking at the S&P 5 versus the S&P 500. There's got to be a reason why, if some stocks are over 30% for this year, why we're not in them.
There's a couple of different reasons, all right? For those of our clients that are in the biblically responsible investment sleeve, none of those 5 make it through the screens. Okay. And 2, as those stocks have really hit that growth phase, they pull back in March 1st. So all of them in that significant downturn in March lost 25 to 35% in the 3-week period of time in which we went risk off before that period really kicked in hard.
Yeah.
And so if a retired client especially were hanging on to those, I think they would probably have wanted out of them in that period of time. And as the money got pushed into the stock market from the Fed, it started landing in the stocks with the largest market capitalization. Okay, so that money sloshing around in the market, it starts to move to the stocks with the largest capitalization. And you really they've gotten overinflated into fantasy land. And here's some of the red flags for that, okay? Those 5 stocks equal almost the same market capitalization that the entire European Stock Exchange equal. So those 5 equal over $8 trillion in market cap, and the European Stock Exchange is just short of 9. Okay, Apple by itself carries more market cap, more price value. I'm not saying company value, more price value than the entire Russell small cap or the Russell 2000 combined. 2,000 stocks, that is.
Yeah.
And the last time. We keep talking a lot about this, and I use the word kind of joking around about bubblicious, but these are big red flags to us. Because the last time we saw something like this, we look back to 1999, so let's go back 21 years, and Microsoft was the number 1 stock in the S&P 500.
Right.
Had a market cap of around $600 billion or so. The next year, it had lost nearly 62% in 12 months.
It's a little bit to stomach.
It's a little bit to stomach, that's right. And so what we know when we see something like this, we know most investors, they won't hang on. They'll say, I'll hang on to this for the long haul. No, they won't. That's why it loses 62%, okay? Because people start selling out of it as it starts to fall. And so when you look at charts right now, you look at a lot of other measurements right now, you see this peaking in the market that tends to happen in bubbles, and it sucks investors in. And it gives traders very itchy trigger fingers. And so as soon as those stocks start to turn down, you're going to see traders bailing out. And not only bailing out, but even shorting those stocks is going to create a cascading event.
Yeah.
And so getting sucked into these stocks right now is in my opinion, is a fool's errand. It's just setting up for a bloodbath.
Okay. Makes sense.
Yeah. And if we're investing for income purposes too, and then we have a 62% loss in this example, then we start taking income, we guarantee that loss.
Oh, absolutely.
So that's not a
no, it's
a good strategy.
When you get into markets like the one we're in, investors get a couple of different things going on. You get statements like "this time's different," and really, what statements like that are covering up people's fear of missing out. And so investors want to start diving into these stocks because their friends are talking about them and how much money they're making. But it gets very similar to people going to the casinos. You know, think about it. Have you ever had a friend come brag to you about how much they lost?
Yeah.
No, they don't. They come brag to you about how much they won. And we've had casinos in Mississippi for long enough that we don't have a fear of missing out here, okay? But markets like this create kind of the same personality, that it's different this time, and I'm afraid that I'm missing out. All of my friends are making money, okay? But keep in mind that markets like this turn right back down. We don't know when. I wish I knew when, but we just know what the data is pointing, that this is awfully frothy. It's very bubble-like, and there's red flags all over the place.
At the end of the day, when you walk out of the casino, it depends on how much you could say you won, but which I've gone to the casino and I've said that, yeah, I'm up $200, and then it's at the end of the day, it's how much do I walk out of there with?
How much did you walk?
Do I have enough to pay for my hotel room and my meals, right? At the end of the day, I mean, we probably have all
when we're
done
talking
that,
about people's retirements, I think the analogy starts to break down. I don't think
we don't want to
play that same game.
Casino type risk.
No.
So the volatility there obviously is pretty violent swings. Even September, Apple was down quite a bit from September 2nd to about September 20th.
Sure. Yeah.
In the range of 20-something%. So I mean, that's a pretty big swing.
Absolutely. I think the hardest part that people have, and I know that me personally, in times like this, it's you kind of feel like the kid in the story The Emperor Has No Clothes. You keep screaming, the stocks are naked, the stocks are naked, the stocks are naked. And when the nightly news or the industry talk shows, you have people still pointing up. And you really just have to follow the data. And it's hard to be patient because we have such an overload of information. We can all look on our phones and we can see stocks going up, or we can see what they do on a day-to-day basis. That's actually very unhealthy, because it does wear on all of our patience. But the truth is, we can look into history and we can see charts, we can see markets that look so similar to today that it gives us a high degree of expectation of what's going to happen in the future. It's not a guarantee. It's never a guarantee, but it gives us a high degree of confidence in what we should expect. And so when you're seeing these danger signs, and we see we've still got a global pandemic, we got a terrible recession, and we got a contentious presidential election, we still have catalysts for these stocks to pull back and come back down. So it's really, to answer your question, I don't want to own any of these stocks. I don't own personally any of these 5 stocks, and I don't want to own any of these 5 stocks, especially not at these prices, because the whole idea is to buy low and sell high.
Right.
Okay. And if you go look at measurements, we're over 2 standard deviations overvalued. Now, that's a really nerdy term. I get it. All right, it's really bad nerdy. But think about it. It's a 45% premium.
Mm-hmm.
That makes it really hard to buy low and sell high when you're buying high.
Right.
You buy them now, most likely you're going to buy high and sell low.
Yeah.
And quite frankly, a lot of the talk that we see going on, it sounds so similar to 99 and 2000, and eventually that's what happened. People bought low, they bought high, and they sold low, and it shaped a decade of the industry. So this is nothing new. History may not repeat itself exactly, but I bet you it's going to rhyme.
Yeah, so there's a lot of headwinds out there.
Yeah, to say the least, yes.
Yeah.
All right, well, thank you for joining in today. So as we talked about everything, and if you haven't signed up or you'd like to sign up for a clay shoot for Delta Streets Academy, because of the potential for the hurricane, it got pushed out. So just let us know if you'd like to participate in that. And
what date is that? That's the 23rd?
Next Friday.
Next Friday. Yes.
Yeah.
Yes.
Woo. Go
It'll
shoot.
be fun. Go shoot stuff.
All right, y'all have a good one.
Thank you.
Thank you.